Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to unpack your stock-related questions is FNB Wealth and Investments' Chantal Marx. Be sure to send those questions via email to stockwatch@bdtv.co.za, SMS on 41392, or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, Chantal. Quite a lot of volatility that we've seen in the market so far. Talk to me about, what you've seen and what you've noticed in terms of what drove sentiment this week in the markets.
Well, I think we need to start at the beginning of January and think about it in the context of what happened over December. So we had this massive Santa rally come through, the market pricing in 7 interest rate cuts by the Fed this year. And then guys coming back from the Christmas break saying, well, what's going to trigger 7 rate cuts? Either there's not going to be 7 rate cuts, or something bad is going to happen to trigger 7 rate cuts. And that really led to negative overall market sentiment since the start of the year.
That's very interesting, because that's the thing. If you look at, if we have those cuts, it's either something really good where inflation comes down really fast, or we get some sort of recession. So it's going to be quite interesting to see what the Fed does this year. But let's actually talk about specific stocks. Today I'm actually seeing Motus going deeper into the red, because yesterday they had their operational update up, and of course they were giving the market an update on the challenges that they faced, inflationary pressures, constrained consumers and all that sort. And then yesterday we saw that share declining almost 9%, but we did see it recover at the end of the session, up about 3%. But today we've actually seen a deepening further into the red. And I'm actually wondering what markets are holding on to here.
Yeah, I am also questioning the moves in Motus currently. So, I mean, if you look at the valuation and the starting point, it's valued very cheaply. I think it's trading on a forward PE of around about 5 times, maybe even less. So what that tells us is that the market is discounting a lot of bad news in the future for Motus. We knew that the last 6 months of the year were going to be pretty terrible. Interest rates are high. This is really bad for a company that is very exposed to consumer lending. And we knew that the consumer was under pressure from a disposable income perspective because of high inflation, which would have impacted their aftermarket parts business as well. So we knew it wasn't going to be great. It was slightly worse than what we anticipated, though. But if you look over into the next 6 months of the financial year and the 6 months after that, suddenly you have this really soft base for Motus to grow off of, and a less constrained consumer environment if we assume that we are going to get interest rate cuts this year, which we do, and that inflation will continue to trickle lower. So I think that the market is overly negative around something that has already happened and discounting in more bad news in the future, where objectively, the future actually looks a lot better for Motus, particularly in this current interest rate cutting cycle that we're probably going to enter into the next 6 months.
Yeah, we'll talk about markets pricing in bad news. A lot of bad news also went into Richemont last year, and a lot of that sentiment was focused on China. China did come out with its economic growth picture for 2023. They even surpassed that growth target. And of course, we saw Richemont, with their latest update, talking about sales growth, and we saw investors coming back into the stock. So with that China story, looking at GDP growth that is okay, would you say that things look better and that all the bad news is out on Richemont at this point?
So I think we had a big shock in terms of Richemont's second quarter numbers. I think towards the start of the last quarter of last year, things looked really weak, and we had similar negative reports coming through from the rest of the luxury goods retailers. And then this narrative was created that, luxury goods is defensive to a certain extent, but it's firstly very dependent on China, and secondly, it seems as if there was a bit of a burst in luxury consumption post-COVID because savings were so loaded. So people who wouldn't usually shop luxury items shopped luxury items during the COVID period or just after the COVID period because they had some extra cash. What this latest set of numbers from Richemont tells us is that things are improving for the Chinese consumer. So even though there are structural issues in that economy, it seems as if the Chinese consumer is actually holding up well and still very much interested in buying luxury goods. And the second interesting thing is that it doesn't seem as if branded jewelry falls within the same category as luxury handbags, for example, when we think about the one-off shopper.
Yeah.
The one-off shopper post-COVID were buying one really nice bag, but they weren't buying Cartier watches and earrings and necklaces. This is a high growth area among the ultra rich. And then another thing was that they gained so much market share in watches because we've seen Swiss watch exports. We've seen the numbers. It doesn't look great, but Richemont managed to grow their watch business. So I think that's why the market was so enthusiastic, and that's why you saw the 11% rally on the back of those numbers. Does Richemont look expensive now after that rally? I still don't think so. I think this is a long-term hold. You can hold it for a really long time and be very comfortable. And I'm still comfortable getting involved at these levels.
Well, since we're on China, of course, that influences commodities as well. And I'm wondering, what's your take on the trajectory of commodities this year? Is it still a hard thing to call, or is it more clearer now?
It's still exceptionally hard to call. So the Chinese structural growth problems or structural issues that I spoke about earlier doesn't necessarily relate to the consumer, and that's why it seems as if Richemont is in a better position. But it does relate to the property market. Property companies are extremely over-leveraged. Demand for property is under pressure. You've got a population that is actually in decline. So that results in the housing market being under a little bit of pressure. And we all know that there are other dynamics at play when it comes to the property market. So we don't expect a lot of building activity in terms of property in China over the next few years, and that will be bad for iron ore, for example, that goes into stainless steel that gets used into big buildings. That said, I think that we are still expecting strong investment in infrastructure globally over the next few years. We've mentioned the elections. I think we've mentioned, or a lot of market commentators have mentioned elections this year. 41 democracies are going to the polls this year. So I think infrastructure investment is going to be a main political tool as well. So I think that should support it somewhat. And then there's been underinvestment in mines for years and years and years, which means at some point we're going to start having a supply shortage, and that will be positive for commodity prices. But I think the road's going to be volatile, particularly this year. There's so much chaos out there. I wouldn't bet on commodities one way or the other, given the uncertainty that we're facing currently.
Quite interesting that you talk about elections influencing infrastructure investment this year. Would you be betting on any companies that could benefit from that? For example, some of the construction counters like Raubex that we have on the JSE?
Yeah, in the South African space, certainly. I know that we've already started seeing tender activity heating up at Sunrail. It has been a story for quite some time. And Sunrail is, apart from a few blips last year, they're pretty effective in terms of actually finalizing those tenders and getting those the shovels into the ground. So in road construction, you would have to back a company like Raubex that is not only exposed to the actual construction of roads and bridges, but actually also supply 30% of total materials into roads across the country. So even if they're not winning tenders, they're supplying materials to the guys who did win those tenders. In the same breath, I think Afrimat would be a key beneficiary from increased infrastructure activity. And then hopefully for some of the other infrastructure guys, it's been very slow. The big mega projects and rolling out those big mega projects has been painfully slow. But yeah, I mean, certainly Raubex and Afrimat I really like at the moment. And then Wilson Bailey Homes, I think, also turning things around nicely.
Maybe PPC as well, because every time PPC has come out with results commentary in the last 2 years, they've been saying that this infrastructure investment by government is slow. So maybe even them. And I actually also want to go into a question. The email is slow to pop up now, but there was a question that was asked by a viewer, quite an interesting one actually, on what analysts think of counters that are exposed to Zimbabwe, like PPC, for example. It was quite an interesting one because obviously, for example, PPC will say that, you know, the operations in Zimbabwe, in their Zimbabwe operations are pretty good, but of course they're still battling with that hyperinflation. So maybe let's start with answering that question of what do you think of counters that are exposed to the Zimbabwe economy?
So I've become a lot less negative around counters exposed to the Zimbabwean economy. And the main reason for that is that most of them have changed their functional currency from Zimbabwean dollars to US dollars. This means that they don't accept Zimbabwean dollars anymore. So they don't have to exchange that into US dollars or into rands. They have US dollars, they receive US dollars, they change that into South African rands. So a big risk has been removed in that regard. And that relates to the hyperinflation story as well. They don't have to employ hyperinflation accounting anymore because they've changed their functional currency, which I think was a pretty smart move and probably long delayed as well. So I'm a lot less negative around that. And I mean, Zimbabwe, it's not the most attractive market to operate in, but there does seem to be some movement in that economy, and there particularly seems to be some movement on the construction side. So yeah, not at all that negative anymore. Then I mean, you've asked specifically about PPC.
Yes.
Shame, man. I think that they've been hoping, I've been hoping that infrastructure investment story starts rolling out. And I think for PPC, it will be very, very supportive, particularly because government will have a local sourcing component to it. Yeah. So those cheap imports that they've been complaining about won't necessarily benefit as much from that infrastructure or government-led infrastructure rollout. But yeah, that said, those cheap imports remain an issue for them, but I think less of an issue if most of the demand comes from government.
All right. Well, as we're talking about infrastructure and property, I know that today Fortress is having a vote on the share structure that they currently have. Of course, they have that dual share structure that they've been trying to consolidate into a single share structure. I'm not sure if anything has happened on that front. An analyst did pick Fortress as his stock pick yesterday, actually on Stockwatch. Would you be looking at Fortress at this point?
Yeah, I've just refreshed my Sense feed. That's why I looked distracted while you were talking. But we haven't had news on the vote just yet. I think that there's a fair chance that the vote is going to go through. And if that is the case, I think Fortress B shareholders will be better off than Fortress A shareholders. So I would expect the Fortress B share price in particular to rally quite nicely on the back of that. After this, after everything is done and Fortress A shareholders get their Nepi Rockcastle shares, there's only going to be one Fortress structure. And I think that is going to be so beneficial going forward. They'll be able to get their REIT status back. They will be able to start paying distributions again. Fortress's underlying portfolio is so attractive because it is mostly exposed to logistics, and the other properties that they have are of a really good quality. So you should expect distribution growth going forward, and for them to be able to pay high distributions as well. It's going to be a wait, I think, with this REIT status thing, but I think that it's going to be a really nice catalyst for the stock.
Well, another thing that is taking place today is the Sasol AGM. Of course, we know that there were disruptions there last year by the climate activists, but they decided to make it virtual today. I also haven't seen an update on that. But of course, there have also been a lot of questions on Sasol, if it's worth investing in. I did see earlier on in the week, it was in the red. I think it did come back today. What do you make of Sasol? Is this something that does interest your money or not?
It definitely interests my money because I can't help but look at it over and over and over again. The stock is exceptionally cheap. And even though oil prices have been under pressure over the last few months, if you are going to, I think the risks are probably to the upside for oil prices longer term. So right now, we might not see a pop in oil prices because there's a bit of a supply glut currently, but there's a lot of risk attached to that supply glut. I'm thinking specifically about kind of an expansion of conflict in the Middle East, and then longer term, I do think that oil price will start climbing again. Sasol also benefits from a weaker rand. So the rand is quite weak at the moment, and it is likely that it will continue to weaken over the long term, just because of interest rates and inflation differentials. So yeah, I mean, I think that there's value there. I don't necessarily think it's a value trap, but I do think that I think investors want to see proof that things are improving there. They want to see proof that some of the one-offs that they've been struggling with aren't more structural. But I haven't pulled the trigger yet. It's a high risk story, right? It's a high risk buy. But I think your risk to the downside becomes less and less and less the lower the stock goes, right?
Of course. Chantal, I want to go into banking and particularly Capitec. There was something that I noticed. JP Morgan was making quite contradictory moves in terms of their buying and selling of Capitec. I think last week they acquired more of the stock where they hold now 5.11%. But on the 8th of January, we did have JP Morgan disposing of its interest in Capitec. And I was wondering, what is up with this? It kind of seems indecisive. What do you make of that? But also, would you be buying or selling Capitec at this point?
So JP Morgan is a very interesting one when they trade. So they trade big blocks of shares, and they trade a lot. And they also make tiny adjustments here or there. So most of the time when you are seeing these announcements come through on SENS, it's JP Morgan buying or selling 0.3% of something. So I think what happened was that they were rebalancing portfolios or rebalancing their prop portfolio. I'm not sure exactly how they run it. In January, they were probably overweight their allocation to Capitec because of the Capitec share price rallying. So they lightened exposure. And then last week, or this past week, they actually increased their target price on Capitec. So that warranted an upweighting in their portfolios. And that's why they bought back more shares. But they trade very frequently. So I wouldn't read too much into that JP Morgan move. And then Capitec generally, Capitec is always expensive. Everyone's like, oh no, there'll be a better chance to buy. There's almost never a better chance to buy Capitec. Almost no one picked it up when it was super cheap after the Viceroy egg on face situation. So Capitec is just I think it's a solid. It's a solid stock. We have seen some upgrades come through on Capitec more recently. I'm still quite positive on the SA Bank space for the next year. So Capitec is certainly one that I will hold.
All right. Well, let's get to your stock pick for today, Chantal. What will it be?
I am going to be very contrarian in my stock pick. I'm going to go for one of the most hated stocks globally currently. This morning, I looked at a graph and a caption that showed that Alibaba is trading on the same price to sales ratio as Campbell Soup. Now, Campbell Soup, okay, they do lots of things, but basically they put soup in cans, right? That's what they do. Alibaba is a high-tech stock with a massive e-commerce platform that is very effectively run and a growing cloud platform as well. They're basically the Amazon of China. We have seen that the Chinese consumer isn't as weak as we expected, and that came through in those Richemont numbers as well. And I think that even though there could be pain near term, this is an excellent long-term entry point into a stock that I think could do exceptionally well over the long term. It's trading so far below its intrinsic value. It's trading so far below its sum of the parts. It's split its business into 6 separate parts, so they have the optionality of actually unbundling and listing companies separately. So I'm going to be that girl. I'm going to go for Alibaba today.
All right. Well, let's drink some soup and cheers to that. Thank you very much for your time today, your analysis today, Chantal. Really appreciate it. That was Chantal Marx from FNB Wealth and Investments.